So here's my completely unbiased, objectively factual truth, whatever you want to say, best dividend growth ETFs list. The key word there is dividend growth, meaning they're not exactly going to have the highest dividend yields of like 15, 20, 30%, but instead their CAGR, which is the compound annual growth rate when you bake in share price appreciation plus the dividends paid out, it's respectable with a capital R. To start out the list is DGRO, and it's the iShares Core Dividend Growth ETF, and it follows the Morningstar US Dividend Growth Index. Its dividend yield usually fluctuates around 2%, sometimes like 2.3% if the share price gets annihilated. And the whole premise behind the index that they follow, they try to filter out all of the low quality companies and instead only invest into the compounders that have at least 5 years of dividend growth, plus a payout ratio that's around 75% or lower, meaning out of their bottom line, no more than 75% of their profits can be allocated towards the dividends. What you don't want to see is a company that's allocating 90% or 95% of their profits for the dividends. Why? Because if there's a speed bump, if there's a setback, if there's an obstacle, if you're using all of your cash, your excess cash left over for the dividends, you are in a sticky pickle. The next dividend growth ETF is FDVV, and it's the Fidelity Investments High Dividend ETF. And it follows Fidelity's own index, the Fidelity High Dividend Index. Pretty simple. And they only like to invest into the large cap, the blue chip, the household names that we all recognize, like NVIDIA, Meta, Microsoft, the big dogs who just so happen to pay a dividend. So it has a lot of exposure to the tech space. And that's why their CAGR is really impressive, while also their dividend yield, it fluctuates between like 2.7 to 3.1%. So it's pretty good. Next ETF is OVL, the Overlay Shares Large Cap Equity ETF. It basically invests into the S&P 500 while doing an options strategy in order to generate a high dividend yield. So when you think about VOO, Vanguard's variety and flavor of the S&P 500, or SPY, dividend yield fluctuates between like a 1 to a 1.4%. For OVL, it fluctuates between like a 4.5 to 5%. Yes, their dividend yield is rock solid, plus their CAGR, it's been about 13% since its inception around like 6 years ago. And then of course my favorite, the tried and true, the battle tested, the old faithful, because their inception, they IPO'd in 2011, so they have a lot more of a track record, history, and a timeline to work with to know that it's not a gimmick, to know that it's not just outperforming during a short bull market run, and that's going to be SCHD, the Charles Schwab US Dividend Equity ETF. It follows the Dow Jones US Dividend 100 Index. It basically takes the philosophy and value system of Warren Buffett of buying into undervalued dividend compounders with cheese that have a juicy dividend profile, and then they sell out of them once they rebound. So they buy into it and rotate out of it after 365 days. The dividend yield usually fluctuates between a 3.3 up to like a 4.2%. And the reason why out of this entire list, I personally invest into SCHD is that since 2011, their CAGR is 13%. That's pretty darn good. However, it's not all rainbows and sunshines when it comes to SCHD, because they do have some holdings, usually around 100 plus or minus 1 or 2 different positions. Out of the 100, I'm not really in love with the bottom 30 or so holdings. It doesn't really matter, because I think the top 10, the top 15 do all of the heavy lifting, because the weighting is like 4% for like the top 10 individually. For the bottom ones that I don't like, they barely make a splash in the bucket. So even though I personally wouldn't buy the bottom 30 stocks that SCHD buys, in the long run, they usually get it right. In the short term, my bias, my emotional lens, even though I don't like those companies because of their filter, their criteria, and their metrics, whenever they buy into a company, I'm not even kidding, I don't know how they always get it right. Not always, maybe like a 90, 91% success rate. It turns out to be fine, and that's why their CAGR is 13%. So SCHD just had their annual reconstitution. I uploaded a video talking about it. Look at their top 10 holdings. We got Texas Instruments making up 5.6% of the portfolio, United Health, Chevron, ConocoPhillips, Coca-Cola, Merck, it's a pharmaceutical company. You got PepsiCo, Verizon, Home Depot, and Procter & Gamble. Everyone in the top 10 is a blue chip household name. And a big shout out to United Health shareholders, because in the past 30 days, the share price is up 31.6%. So like I said, SCHD, they usually buy into the beaten up, beautiful compounders while they're on a discount. They get it right. Now, obviously, this ranking tier system that I shared with you could be flawed, because it's just my personal opinion. Who do you think I'm missing? Which ETF do you think belongs in this conversation for being the best dividend growth ETF? Keep in mind, I did not include the high yield passive income generators of like 10, 15%. Okay, this is the name of the game is CAGR. Let me know.